Yeah, so it definitely took longer than I would have liked. And now I know it's always better to be in the market, right? It's always better to invest early and just build equity rather than wait. But it is what it is. The best day to plant a tree is today or 20 years from today. So,
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is the Trinity of Freedom: time, financial, and geography freedom. I'm your host, Missy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I'm on a mission to help hundreds of thousands of people like me to do the same.
Hey, welcome to another episode of the American Dream Builder and Investor podcast. I'm your host, Missy Liu, and today we have another cool guest with us here today. Her name is Deepa Akula. And I'm very excited to dive into this a little bit more with her because today she's going to talk about her experiences, not only as a first generation immigrant like me, being from an engineering analytics background, but also her experiences of passive investing and how she's actually now a full-time syndicator as well. So a little bit bio about her that tells you about her story a little bit more. She currently is a full-time investor in the multifamily space, and she's out of Seattle, Washington. She's a general partner for over 1,300 units and a limited partner over 1,700 units. And the limited partners is a little bit over around 8 to 9 different deals, and they're mostly in Texas, Arizona, and Florida. She's also an engineer by trade in the civil and structural engineering areas. She's also licensed in the area. She also holds a master's degree in mechanical and aerospace engineering. And without further ado, Deepa, welcome to our show today.
thanks, Missy. It's a pleasure.
So, Deepa, I know that we have a similar background with our first generation immigrant stories. And I think you
Right.
mentioned to me another time that you came here for a master's degree in 2005. So, I just wanted to tune into the mindset a little bit because with me, I just was here for education. Education was so important for us, at least for Chinese. So I never was taught any of the entrepreneurship, investing, things like that. Was it similar to you?
It was, yes. It was very traditional thinking that we have to go to school and find a job. We were taught economics, but it's just to understand how economics works, but not to be an entrepreneur or start a business. So
Yeah.
it was pretty similar.
Yeah, it's crazy. Sometimes when we're dealing in and out into the numbers as an engineer or analytics person, or even like looking at finances, but we're not realizing how it could be helping us changing our lives better. I see so many people working in real estate space, maybe as an agent or broker, but they don't invest in it themselves. They just, make it like a hourly based job mindset. So I'm glad that eventually you were able to make that shift. I know that you started looking to passive investments, specifically real estate syndications in 2016, but you didn't start investing until 2019. What took you so long? Because a lot of people are probably similar to you. They're just watching, looking for the perfect time, whether it's stocks or real estate. But you took 3 years, which I understand. Engineers sometimes would like to collect data.
Right, right. That's exactly what it was. I just wanted to collect data. And now I understand that you don't really need to know how to underwrite a deal before you invest. You just have to understand the business plan and invest. If you really like the property and you're almost betting on the syndicators, right? The syndicators, if they have a good track record and if the property makes sense, you just invest. But in 2016, when the idea kind of came to me to invest in real estate, I did not know any of the syndicators. And I did not even know people that were investing in apartment syndications. Now there's so much information and there's so many of us that have invested that we can draw from their experience. I felt like I was kind of alone and needed to do a lot more research. And I did have analysis paralysis, and I knew how to underwrite before I invested as an LP, which was total overkill. But that kind of took me a long time. And I have a boy, 6-year-old now. And back then he was an infant. So taking care of an infant and having a full-time job, it took me a lot longer to build up the confidence to invest.
I see. Yeah, because I see a lot of first and second generation immigrants, which is what our podcast is for. A lot of times we come to a new place, new country with skepticism. So when we encounter new things, we have a lot of skepticism. So you had to establish a community. I know that you joined some type of membership programs, being around people who wanted to do similar things as you, and you collected data points, found the right sponsors. Would you say it would have been better if you started investing earlier? Or are you happy with the fact that you waited because you felt comfortable with your decision?
Yeah, so it definitely took longer than I would have liked. And now I know it's always better to be in the market, right? It's always better to invest early and just build equity rather than wait. But it is what it is. The best day to plant a tree is today or 20 years from today. So
Yes.
I wish I started early though. Um, but the minimum investment is 50,000, right? Sometimes. And that's kind of where I started. And I was like, okay, if I'm investing 50,000, even angel investors, they kind of split up their checks, like they 10,000, 25,000. In syndications, it's 50,000 and all your chips are just in that pot. So
Yeah.
now I know how to do due diligence better.
Yeah, definitely. It's a learning process for everyone. And you have your passive investor experience, and now you're helping others to do some of that as a syndicator as well. And you also do angel investing and also stocks as well, right? Kind of a
I do.
complete portfolio without 100% being real estate, which are what some people are doing. So I like that how you're balanced as well. And so essentially you in 2019 you started investing, and then I know in 2021 unfortunately you lost your job, or fortunately you lost your job that pushed you over. So help us understand, how did your passive investment help you stay in real estate full time, or make that transition to entrepreneurship a little bit easier?
Definitely. So, in the way I started, I was looking for a place to invest my capital to begin with. That's kind of how I started. And we were paying way too much in taxes. So, I was looking for tax advantage investments too. That's kind of how I ended up in real estate. And as I was doing that, I kind of understood that, hey, this is a lot more fun. And I was head of engineering at that time in 2021, early 2021. And I go, I like numbers and people, and real estate is also all about numbers and people. So I thought they're very, very similar. And I was kind of grooming one of the engineers that was in the department to take over. And unfortunately, the market turned and lumber got really expensive, and they completely shut down the engineering department. Then I thought, oh, now it's my time to see maybe find another job, because I had 3 or 4 other offers in hand. I could have went that way, but I did not want to take another 8 to 5, and thought I was already in the real estate space as a limited partner. And because of the distributions we were making during group gatherings and things like that with friends, they wanted to get into syndications. And there was all 506B syndications. So I had to be a general partner to bring their equity into the deal. And that's kind of how I became a general partner. The scope was just to be a limited partner and just keep working. But because of necessity, I was tapped to become a general partner so that I could place equity from friends and family into these deals. And I was doing both, being a general partner and work W-2. And when the time finally came, I was like, oh my God, this is awesome. I can do full time. And, we had invested in a lot of apartments by then, and we were making good cash flow from distributions. So that kind of gave me a cushion so that I was not freaking out because I lost my income. We actually had part of our bills covered by then from passive income coming in. So it really helped me push in that direction.
Yeah, that makes sense. And sounds like you started with just wanting to have alternative source of income, then you moved into necessity, and then moved into helping others to do the same.
Right.
Any other reasons you're passionate about real estate investing?
I'm really passionate about how it broadens the alternative investment space to so many people that are actually qualified, but they don't know about it. Stocks go up and down, but with hedge funds, which actually help you invest, with higher returns, if they get there, many people don't qualify because they want minimum $1 million check to even take your money.
Yeah.
So we are serving our friends and family that are accredited investors and maybe sophisticated investors invest in this asset class. And the thing that I'm really excited about is it's a win-win-win. It's a win for the investors because they're making good returns. It's a win for the residents because we go in and make the apartments better and implement community events. So we are making the property a better place to live for the residents, and we are hiring people for staff. So we're providing jobs. And, we work W-2 jobs. There's really nothing against it. That's kind of how I built my income so that I could invest. The income or the profits that we generate from that goes to the headquarters, wherever that is. Mine was in Canada, so it leaves the country. The money goes to Canada. But here with apartment syndications, if you do a good job, the money is really not going very far to your family and friends and other investors. It's just going to getting split and it's not going very far. So I really like that idea.
Yeah, that's awesome. It's like creating another smaller community of impact, helping them out
Right.
financially and helping them see purpose beyond the numbers of money. So
Right.
that's awesome. Yeah, I love that. With all the deals you've invested in, I think this will be a good education opportunity for people who are contemplating about investing or just started investing and they're trying to understand what's happening. Obviously, when you start investing in 2019 to now, the market has been very different.
Right.
But typically in the value add process, the cash flow continue to increase throughout the time of the hold. So when they start investing, let's say for the first year, what should they be expecting about what's happening in the first year in terms of distribution? Is their first quarter distribution going to be very similar to the fourth quarter distribution? Or is it going to be averaging about what the sponsors are projecting? How's that experience? Because a lot of people are just concerned about what people are projecting is not true to what's shown on the PowerPoint or the presentation.
Right. Right. No, which is why you really have to know what the track record is for the syndicator that you are working with. An experienced syndicator would know if they can hit the projections and they're going to underpromise and overdeliver. And, usually if it's a 7% pref return, that 7% is very difficult to get from the first distribution. The distribution might happen maybe in the first 6 months of ownership or maybe even after a couple of quarters of ownership, but it will be lower than that. And it will keep on increasing if it's a value add, as the syndicators renovate and bump up the rents accordingly, then the NOI, the net operating income, is going to slowly go up. And maybe after 2 years or 3 years of ownership, they're going to hit that 7% yearly, which is paid out quarterly. And then maybe it'll go higher after that and average 7% or 8% overall.
Yeah. And it depends on the deal. It's important for people to know because I've had investors that come to me. They're like, I remember it's 2x your money. That's what you're projecting in 5 years. And that's going to be maybe 10% cash flow on average. And I'm only getting, let's say 4% or 5% in year one. What's the deal? So I think having that expectation, knowing those details are really important. So you can set yourself up for success in your financial planning. Yeah, definitely. Right. So as a passive investor, now also helping others to invest, what are some of the things you're seeing passive investors usually don't know much about until they've actually invested in it? And whether it's, people didn't disclose it to you or you didn't read it because there's too many things to read. We just didn't think about it because it's really hard to measure the amount of risks involved. That's why we have the PPM, private placement memorandum, to disclose the general risks involved.
Yeah. So that's a great question. Thank you so much. After doing this for this long, I start with the risks because if some of that doesn't work, then it's not a good fit, for the investor to invest in. Some of them are just nuisances, like having to extend your tax returns because one of your K1s is late. But to begin with, I always tell limited partners, do not invest the money that you will need it anytime soon. Yeah. These properties are illiquid. So understand that you're in the property for the time until we exit the property, unless there's a catastrophic event or something that somebody has passed away or there's a bankruptcy. In those cases, there might be a chance where somebody will buy out your shares. But assuming everything goes well, and do not invest the money that if you lose that money, you won't be able to put food on the table. So this is an investment itself means you're putting the money at risk for a higher return, right? Which is why we don't put it in the bank for lower return. We put it at risk of losing it. Although the risk of losing it is very low if you invest with the right people, but it's still there, right? So the risk, you really have to consider that. And it's illiquid, you definitely have to consider that. And sometimes you have to extend your taxes. Tax returns, you may not be able to get it done by the regular deadline. You may have to file for extension, which is actually a good thing. If you are filing for an extension, that means you're in the next level of earners. You're
Yeah.
becoming sophisticated just by because you're having to extend your taxes. But for people that are not used to it, it is an annoyance. They're like, oh my God. But know that that'll happen. And the distributions won't be 7% or 8%, whatever the pref is right off the bat. We'll slowly build up to that and maybe exceed. But yeah, those are the things that LPs would need to know before getting in.
This podcast is sponsored by Life Mission Capital, founded by me, Missy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
Yeah, those are very good. I want to kind of follow up on two things that you mentioned. One is the risk aspect, because we know people talk about the stock market a lot. The stock market, yes, maybe it gives you 8% on average return, but it's the volatility, right? Like within the 10 years, you actually need it to grow to 8% per year. It may be like maybe only 2% per year, but the next 10 years, we don't really intend to invest in it, may grow 20%. That's a little bit exaggeration, but with real estate, it's a lot more stable, but there's still risks factors involved. So it's good that you start with the risks. That's how I like to look at deals, to understand the risks and then go into other aspect. And the other thing you mentioned is about the taxes. Some of the investors we deal with, they use TurboTax for so long and they get panicked when they're like, oh, I'm not going to be owing taxes if I have to delay it. So it's good that you brought it up so people know that that's normal when it happens. So I know you've done so many different deals, but mostly in the multifamily space. And we talked about how we both share the love for numbers, being engineers, data analytics person. So we take our underwriting very seriously. Actually, similar to you, I was an overkill for my first investment as well as a passive investor. It didn't take me as long, but I did also try to learn how to do the underwriting to do my first investment. But I actually ended up not looking at underwriting because I just went with the syndicator, even though at the time I already got all the numbers, how everything works together, figure it out. So would you like to touch on what are the things you look at for underwriting?
Yeah, sure. The first thing would be take a look at the market and the submarket. And for underwriting, the first thing is I want to see, even though this comes under the market, I want to see if there are jobs growing in that area for the past 10 years. And if there's job growth, there's population growth, right? I would like for population growth to be at least 2% year over year. And if those are there, then the property itself, if it's in a coastal area, the first thing I would check is that it's not in a flood zone. And these are not numbers, but if we don't look at this, their premium for insurance will be super high if that is in a flood zone. Underwriting wise, I want to see where the current rents are and how many units were renovated and how much upside there is, what the market rents are, and what we can get for post-renovated rents. And DSCR, which is the debt service coverage ratio, I would like for it to be at least 1.6 if not 1.8. We've had deals over 1.8, but in current environment, it's very difficult to get those. Banks will lend it to you at 1 point. They used to at 1.2. Now they're increased it to 1.25 because of the risks in the market and the interest rate. But I would like to be conservative. And just the property size itself, some people can make it work with maybe 75 to 80 units to have a full-time staff, at least a couple of people. But those run really tight. So I would like for the units to be at least 150 units at the same property, not a portfolio, but in the same location, at least 150 units. And some of the other things I look at is the unit mix, if it matches with the demographics. If there are households and if there are many households and average person per household is 2.8 or 3.2 or what it is, it's more than 2, then for those submarkets, we need at least majority of the property has to be 2-bed, 2-bath. If there are households and if all our property is 1-bed, 1-bath, it just is not a good fit. So sometimes it's a good fit. If it's near university, then 1-bedrooms will be just fine because that's all students need. So the demographics has to match the unit mix, or the other way around. The unit mix has to match the demographics. And the income, median household income has to be at least 3 times and of everything, not just the rent, but the rent and the utilities and everything together, it has to be 3 times that. In some areas, if it's for students, we can take that down to 2.5 times, but usually it's 3 times. The income has to be 3 times whatever they're expected to pay us. And what else? What else would you like to know, Missy? I
think that's a great list already. You touched on some of the underwriting about, essentially, the underwriting is really about income and expenses and the debt payment. All those factors affect cash flow. And also when we sell, actually, I also have some episodes in the earlier episodes that talked about those different levels of underwriting as well. I think you
Nice.
covered it pretty well. And some of the things people don't talk about as often was the unit mix, which is very crucial. It's also affecting the sales comp as well. You know, when people look at Class C selling for $130,000 per door, is that a 1-bedroom or 2-bedroom? Do you have majority 1-bedroom or 2-bedroom? So that's
Right.
something I see people tend to forget when they bring it up. Now, let me ask another follow-up question more as a passive investor, just kind of thinking from people who are looking to passive invest. Sometimes they have questions like, if you have to check all those things, then I might as well become an active investor, or I might as well just do my research on the stocks. Well, what do you think about people who feel overwhelmed with the amount of due diligence that can go into a deal?
Yeah, that is mostly for a syndicator to look at, right? I wouldn't really expect the limited partner to do all of that. I would expect the limited partner to really depend on the information that their syndicator is providing, because we are doing all the research anyway, and we could provide the demographics and the unit mix and growth, population, job growth, everything year over year. And if you keep on investing with the same syndicator, you kind of know their system and their research. And these presentations that are actually put up, right, as webinars when they roll out the presentation, the property to everybody, those become part of the PPM. And they are legally binding. The syndicators can't just put anything up there. So any information that your syndicator puts on in the presentation is part of your PPM. And if they didn't talk about the income, then you just ask a question about the income. It's really high level. For investors, it's really easy to know population growth, right? Real quick check. Job growth, real quick check, and unit mix and income, right?
Yeah, definitely. I know that's for some passive investors, they find it challenging to put a trust in because it's a 5-year deal, but
Right.
also some, or 3-year deal. But some passive investors, people like you and me, once you've had the experience and know that person's capable and credible, the numbers check out, it's much easier to put the numbers. Because think about it. In the public traded companies, you place capital in there, you have almost no control in how companies react. When Elon
Yeah.
Musk says something on Twitter, the next
Yeah.
thing, the stock market moves crazily. I feel this is much more controlled. Your access to syndicators like Deepa or I being able to explain to you how things are going. I feel it's a lot more easier access to the data and makes you actually feel more relieved at what's happening because the rent doesn't change as much as stock market. Did you know that Amazon, they missed their earnings by like
87%.
yeah, it was a huge amount just because of one investment they made in the vehicle. Their stock prices in there went down by like 90% plus.
Oh,
So
yeah.
this is much to me, much less turbulent and much assuring in my heart because I would know rent and expenses don't just skyrocket and
Right.
change. Yeah.
Right. And you have a person to call up and talk to, right? Hey, what's going on? How is the property doing? And most indicators have newsletter or some kind of update going to the limited partners. So you kind of go along what the progress is. So you're not blindsided by something that's going on at the property.
Yeah. And playing devil's advocate, what are the things? Was there anything that you have been experiencing as a passive investor or you have seen as an active investor you felt like isn't really good in the real estate syndication space that people should be aware of or look out for?
Oh, vetting the sponsors, I would say. Just vetting the sponsors, and you really have to invest with somebody that makes you feel good, answers all your questions, and trust your gut. If they make you feel good after you talk, answer all your questions, and they're data oriented, then I would, feel comfortable investing with them. I've yet to had like a bad experience with a syndicator that I've invested with.
Oh, okay.
So
Tell us about the experience without obviously mentioning their name unless people are interested in following up with you.
yeah, no, you know, the communication has to be there no matter if it's flat going up, down, or sideways, as long as there is constant communication as to how the property is doing, then there is communication, then people assume the worst, right? The investors are like, oh my God, what's going on? So the best thing is to keep communicating no matter what is going on and being super transparent. Little things will happen that maybe a community manager is not working and they need to be replaced. And limited partners being limited really do not need to know that at all because it's just more things that they need to know that doesn't affect the performance of the property or anything like that. But numbers wise, how many units are renovated and what are the rent bumps that are getting and how is a syndicator making the community get together. If you feel the residents like they're part of the community, they'll stay longer because the most expensive part of owning multifamily is the turns during the whole time, right? Somebody vacates after being there for like 6 months. Then you have to clean the carpets, repaint, do whatever needs to be done. That's more expensive. And the unit is not paying. There's no one living there. So, we are spending money and not making any. So if we make the residents feel like they're part of the community. So look for syndicators, ask for their cadence of communication, and ask how they would communicate if something goes south and how they make their residents feel welcomed so that they keep renewing their leases.
Yeah, that's a great point. Transparency is something I really value a lot when I look for partners, especially like you said, no matter how it is going. And I really appreciate some of the partnership because of their transparency. I love monthly update, even if it's just like 10 sentences or two-liners sometimes, if there's nothing much going on after stabilizing. But the
Yeah.
transparency, put especially first-time investors or people who are first-time investing with you at ease. Yeah. Deepa, coming to the end of the show, is there anything you like to cover that you think it would be good for our audience to know?
Yeah. I would say keep learning, even if you're a LP, GP, wherever you are, just keep learning and adding value to others. It'll go far.
Nice. Yeah, I think that's how you started, right? You started by adding value, networking with other people. So yeah, appreciate it. Is there anything else you'd like to leave in case listeners want to get in touch with you?
Sure. You can find me on LinkedIn. My full name is Deepa Akula. And my website, it's Vinside with a V, Vinside, vinsidecapital.com.
Okay, awesome. Well, thank you so much, Deepa, for sharing with us today your experiences from a passive investor to syndicator and some of the key things that other potential investors can watch out for while they're looking or considering to make the investment. Appreciate your time.
Oh, yeah, it was a pleasure. Thanks for having me on, Missy.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Missy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.